A very good evening, good afternoon, friends, to all of you. I'm Sanjeev Singhal, Central Council member and chairman of the Auditing and Assurance Standard Board and the Sustainability Reporting Standard Board of the Institute of Chartered Accountant of India. I, along with my vice chairman, who will join us shortly, CA Vishal Bhai Doshi, we welcome you to this yet another program of the Auditing and Assurance Standard Board. Today is the 49th program of the AASB in this council year. This is a combination of the physical programs as well as the virtual programs, and more than 1 lakh members have already attended these various programs on audit. And it's been our endeavor to cover all the aspects in the audit of financial statements. And so far, we have covered all the auditing standards. We have also covered company's auditor report order, and now we are going to particular themes around the audit. And then we will be starting sessions, a series of about 15 sessions on the audit of individual item in a financial statement, which will cover the Companies Act requirement, auditing standard requirement, CARO requirement, and the requirement of the accounting standards and auditing standards. Friends, today's topic is fraud risk and the procedure in audit. It's a very, very important topic given the heightened expectation of the society and the increasing expectation gap. And it is our duty as auditors that we comply with the requirements and the expectations from the auditors. For today's program, we have two very esteemed speakers, CA Amit Mitra and CA Rajiv Saxena. Amit is also a special invitee of the Accounting and Auditing Standard Board. And both Amit and Rajiv comes with a lot of experience with them and have the experience of working in large firms. So they will share the practical experience. And both of them were also, they are also involved in many of the projects of the Auditing and Assurance Standard Board. I welcome both of them and express my sincere thanks to both of them for taking out time for the activities of the Institute from time to time. And now I have the pleasure of introducing my chairman in the first year in the council in the last term, Dhirubhai, we call him, Dheeraj Khandelwalji from Mumbai. He was the chairman of the Public and the Government Financial Management Committee. And together, under his guidance and leadership, we were able to achieve a lot that we wanted to do in this committee. Dhirubhai is a person with astute intellect, quick understanding, and a sharp vision. He has more than 2 decades of experience and has been elected for the 3rd time into the Central Council of the ICI, and he has served 9 long years into the WIRC. He is currently the chairman of the Committee for Development of International Trade Services and WTO Committee on MSME, where he is doing a very pioneering work, meeting the relevant people every now and then and working for the cause of the MSME and startups and the profession. He's also a vice chairman of the Committee for Member in Public Services and Entrepreneurship of ICI. His entrepreneurial journey with expertise in the field of business advisory, planning, project finance, angel investing, mentoring startups, along with excellent organizational skills, envisions the accounting profession across the globe. His contribution to the council is immense. He has done many innovative things. As a chairman of the Committee for Member in Industry and Business, the way he shaped the agenda for the industry is really remarkable. And same is happening with the Committee on Public and Government Financial Management as well as the MSME. He has authored books on the green audit, CSR, along with his involvement in the Lions Club of Mumbai. We welcome you, Dhirubhai, and would request your inputs as a keynote speaker on today's topic, that how it is gaining importance and how it is important for our members to apply the appropriate fraud procedures while conducting audit. Thank you for coming, and over to you, Dhirubhai. Dhirubhai, you are on mute. Kindly unmute.
Thank you, Sanjeev, for your nice introduction. I think I remember my first year of this committee in the Public and Government Financial Management, where you were my deputy chairman, I can say. I can say it's a wonderful experience working with you, because what I got the credit is because of you only. And I've seen that your zeal and working in this particular very first year of the working. Though you belong to a big cloud from the big firms, even we could not able to see your thought and working like with the big. So you always be with the people. You always have the zeal, to serve to the members. You have the zeal to work towards the member at large, member at society, which I've seen. It's a tremendous, and that's why I admire you always. Whether you will be in the member in practice in the committee, where you did the marvelous job about more than 50 to 60 MOUs which you have done it, and the kind of getting a leadership to giving to the members at fraternity at large. So I can say it's each and everything you worked in the last 3 years in the council, in the last council. I remember in my committee in the very first year, in the committee for public and government, where you came out all the accounting standards. Being I'm not a not technical, you were the technical person. You worked with the administrator as well as technical part. So I'm very surprised to see that you chosen me a keynote speaker. I'm not a expert in this particular domain area, but I can say I'm not be a fit person in the auditing and the assurance part. But from last 10 years, I've left it the working in this area. But I'm surely connected, always connected in the accounting and auditing field and my firm. I've seen a lot of challenges in this auditing field. We previously, 20 years before, the audit was very simple. You have to just, fair and true and fair view, which you used to give in it. But after a decade, there we have seen a lot of turmoils, a lot of companies, fallen down, and the responsibility has been came to the auditor shoulders. What the auditor is doing. It's always been questions whether it's a members at large or whether it's a society at large, whether it's a government at large. Every people talk about whether it's a auditor is what they are doing it. So always be the slogan is there whether no auditor is right wrong. So a lot of things being discussed now. We have seen 4 years before also a lot of turmoils been happening in the companies audit and the grounds. So always there will be questions on the auditing side. So things are changing by the new government has came. They wanted the more responsibility on the shoulder to the government, to the chartered accountant. That's why they came out the change in the CARO, and where the risk and responsibility has increased. And now we, apart from the certifying the financial statement, we have to look about the fraud risk. So as of now, we were not taking care of the fraud risk. We always signing the financial statement with the true and fair view. Now the responsibility has came out to the sort of the auditor. Let's find out where the faults are there, and let's find out where the frauds are happening. If it is there, how the statement has to be prepared, and what the quantification or adverse view which you can give it to the management and auditor. So these are the topics are there, and I'm sure about it. Sanjeev Bhai is doing the wonderful job to having awareness in the members at large. What our responsibility is, and that's why this awareness series is planned. And this is the 53rd program which is happening into this committee. It's a tremendous within just a span of 4 months. I can say it's within the span there are hardly weeks in the 4 months, and 56 program which is doing almost 1.5 or 2 program every week which is conducting and mobilizing the all people for the awareness of the member at large. And I request my members, this is important topic. There where the two speakers, Rajiv Saxena and Amit Mitra is there, and they will discuss you more in the technical side, how the auditors can plan their audit and what way they need to donate, and how the balance sheet can be presented, and what the risk assessment has to be taken care of it. All the things are being going to be discussed today program, and I'm thankful for the Sanjeev Bhai to taking care of this particular area where the members at large are got stuck. What is the definition of the fraud? That's always be a question mark, and I'm sure about it today. Derivation will discuss, because sometimes fraud definition is very broad in terms, and it is not comes under companies at 136 whatever may be there. So I believe that there are very much deliberations today on the fraud and how it can be represented into transition. With this, I'm thankful for the all committee and members for attending particular this webinar. With this, I think the great program going to be there, and once again, congratulations, Sanjiji, for organizing such series.
Thank you, Dhirubhai. Thanks for the kind words and the encouragement that you always provide to your council colleagues. Thank you so much.
Thank you very much.
With this, thank you, Dhirubhai. With this, now we move to our experts, two experts, Amit Mitra and Rajiv Saxena. So between the two of you, Amit and Rajiv, who would like to speak first?
Yeah, so I'll be going
Please go
first.
ahead. Please go ahead.
Okay. So thank you, Sanjeev ji. Thank you, Dheeraj ji. And thanks to my fellow speaker, Rajiv. Good afternoon, everyone. The topic indeed is extremely relevant in today's day and age. I'll just put my slide and then we'll start the deliberation. Is the screen visible?
Yes, sir.
Okay, and I'm okay. Okay, so between Rajiv and me, today we will touch upon the reporting of fraud and how it is defined in the Companies Act, what are the expectations, and what is the procedure to be adopted by the statutory auditors very specifically. And as Sanjeev sir rightly mentioned in his inaugural comment, that today the expectations from the society and the regulators is far different than, let's say, as compared to what it was 5 years ago or six years ago. So there are enough sections, there are enough rules in the Companies Act and in the other laws also, like the SEBI and other laws. There is some mention in the Code of Ethics also as to what the auditors should be doing. So though it is a procedural thing, procedural topic, I have just to make it slightly more interesting, I have added certain case studies, certain examples, just to make it more interesting. This is what we're going to study. What is the meaning of fraud? Dheeraj ji rightly mentioned whether a particular activity gets covered as a fraud, or if it is covered as a fraud, what are the auditor's responsibilities in terms of reporting it back to the management or reporting it back to the central government. Then I will slightly touch upon SA 240, though Rajiv probably will well on this in some more detail. Section 143, subsection 12 primarily talks about the reporting requirements and what is the procedure to be adopted by the auditor. And then there is this Rule 13 under the Companies Audit and Accounts Rule, which spells out the specific procedure to be adopted. And then also it is important for an auditor to identify the stage at which the fraud is to be reported. Let's say, for example, if there is a fraud detected, is it expected that the auditor can probably report to the central government at the end of the audit, after or let's say after 6 months down lines, after 6 months of finishing of the audit? What is the timing of the reporting of the audit? That is also well defined in the law. Okay, so starting with the dictionary meaning, it is like let's say any common man would understand. Fraud is defined as the crime of getting money by deceiving people. So there has to be an intention to deceive people, and it is an intentional activity to gain unauthorized and illegal personal benefit directly or indirectly against the organization or against the government policies. So you would try to correlate. We had certain issues. We had certain management playing fraud on the company by claiming excess refunds. Is that against the government policy, or people trying to claim certain benefits which they are not entitled to do? Whether that gets covered, into fraud or no. So all those things would be deliberated. But within the definition, if the intention is to deceive, or if the intention is to uh, is is to uh, is to get the gain, unauthorized or illegal gain, then it gets covered in the fraud. So let's say in case of I'll take an example here. Now this is a case, and this is a live case where some some land buyer wanted to acquire a particular stretch of land, where he had the information that this land, and he was in the business of oil exploration. So this person was aware that this particular stretch of land, based on a particular report, will not have any oil in the land. But he purchased the land, and then he changed the report, the geologistic report, and went to the investors to gain money, and just to showing the reports that he's going to do, he's going to perform certain activities in that, and this land is favorable for oil digging and all. So he got all the money. Now what happened is that, to ensure that he's actually doing the right thing, and also that he is actually doing the business activities, he hired someone to do the digging of the oil and all. And to everyone's surprise, uh, he was able to find some oil in that piece of land. Now the question is, and it's you may call it a hypothetical question. Now the question is whether this person actually deceived the investors or no, because investors were able to get the recovery of the money, but when at the time of solicitation, it was he was trying to play a fraud on the investors. So here probably the ruling said, and it adds on to the definition, that the fraud needs to be seen at the time of solicitation, which is at the time when the person is initiating it. That is the time he has done the thought process is going to play a fraud. So it is extremely important for us to understand the intention of the person. Moving on, there is this section 447 of the Companies Act, which now explicitly defines what would get covered in the fraud. And obviously this is from the point of view of the company and the entity. And from our perspective, from auditors' perspective, it is extremely important to understand each and every word of this definition. So I will read this verbatim, and then probably we'll leave it there, and we'll cover certain examples just to see how this would be understood better. So fraud in relation to the affairs of the company or any body corporate includes any act, omission, concealment of any fact, or abuse of power committed by any person or any other person with the connivance in any manner, with intent to deceive, to gain undue advantage from, or to injure the interest of the company or its shareholders or its creditors or any other person, whether or not there is any wrongful gain or wrongful loss. So they've tried to cover everything. They've tried to cover the shareholders, they've tried to cover the creditors, all the stakeholders, you name it, it's covered. The government, if you're doing something wrongful gain for yourself or for the company with the government, it gets covered. Now, what exactly is wrongful gain? So wrongful gain means gain by unlawful means of property to which the person gaining is not legally entitled to. So very simple, as probably a normal layman would understand. anything which you are not entitled to, and if you try to gain an advantage over it, it is a willful gain. And sorry, wrongful gain. Wrongful loss primarily would means the loss by unlawful means of property to which the person losing is legally entitled to. And again, moving forward, so we'd covered the definition of 447, and moving back to that slide, we would see that it covers any concealment of fact or any abuse of power or position to get the wrongful gain. And then we have seen that it also covers the category, the stakeholders, the category of people, and it also covers whether we are trying to injure the interest of not only the company but to the other stakeholders. So it is quite wide, you would have seen. Now this definition as per 447 has to be read in conjunction with SA 240, which is again quite similar. And SA 240 is more focused on the auditor's responsibility of the fraud. And as I've mentioned as a chapter heading, it says, are all frauds detectable by by auditor? Whether an auditor would be able to detect all what is given in section 140, section 447. So it's basically says fraud includes acts with an intent to injure the interest of the company or its shareholders or its creditors or any other person, whether or not there is a wrongful gain or wrongful loss. However, is auditor able to detect all the acts of fraud? And we have covered certain examples where all of us will agree that all the frauds cannot be detected, especially by the statutory auditor. It says an auditor may not be able to detect the acts that have an intent to injure the interest of the company or cause wrongful gain or wrongful loss to that particular person, unless there is a financial impact that is reflected in the books of accounts of the company. So this is extremely important. So by the plain reading of 447, you would have got scared as to how an auditor probably would be able to cover everything in the gamut. So then it has to be read along with SA 240, and then only certain aspects of the overall gambit of fraud are to be covered, which primarily means if there is a financial effect to the books of accounts. Okay. Now in example 1, so this employee was receiving a payoff for favoring a specific vendor. So he was asking, let's say, a kickback from a vendor to give him more business. Now, obviously, this is a fraudulent act, and since such payoff, since he was accepting a payoff, and it technically gets covered in this in section 447 definition. But these payoffs or anything, nothing gets recorded in the books of accounts of the company. So obviously this is not detectable. This is something which probably an auditor may not be able to detect or will not be able to detect with any kind of procedures, because this is off the books of the balance sheet. So I'm just trying to give these examples as to what would create a distinction between what an auditor can catch, what the street should expect, what the regulators should expect. And these all examples are from certain guidance notes issued. The second example here in this case, a password was obtained. Password of key managerial person was obtained by some employee, and he got all the confidential and restricted information. Again, this is something the person or the employee was able to take benefits on his own personal account, and there was nothing recorded in the books of accounts. Again, in this example also, it cannot be determined either by the management or by the auditor, let alone auditor. Even management can't also determine or catch these kinds of fraud in example 1 and example 2. Okay, in example 3, Here, in this case, the employee was carrying on a parallel business, and then he was diverting the customer orders to his own company. Now, from an auditor's perspective, he's auditing the books of account, whatever is recorded, whatever the sales gets recorded, or whatever the purchases get recorded. But this is the technical fraud. This is the technical fraud. So in this case also, it was kind of concluded that auditor will not be able to detect these kinds of fraud, which doesn't have any record in the books of accounts of the company. Now, an example for again this is pertaining to the tax evasions or tax planning, and all of us, this is very close to everyone's heart. All the practicing community, we do a lot of work on the tax front, and all of us know that there is a very thin line of difference between let's say tax planning or tax evasion or a tax fraud. So tax fraud and or tax evasion is an illegal activity having deliberately and intention to avoid paying of genuine tax liability due to misappropriation, which is deliberate or which is intentional. And so let's say to give an example, if the documents have been falsified by the management, then it is a clear case of tax fraud. However, if it falls within the bracket of tax planning, then it is obviously not a fraud. So one needs to be wary of the fact as to what is the intention of the person, what was the intent at the time of making the tax assessments or the tax provisions or the claims of the refunds and all. If he has falsified on certain documentation, then it is a clear case of fraud, and it is not a tax planning. Okay. So now another question comes, and statutory auditors generally say, and before I read this slide, I would want to share certain statistics. So a survey was done by some large institute as to what is the percentage of frauds which get detected by, let's say, the statutory auditors. And to everyone's surprise, only less than 5% of frauds are detected by the statutory auditors. So, and then generally who detects the fraud? So majority of the frauds are generally detected by the management, or there is a whistleblowing, which is a very large percentage of detection of fraud. Internal auditors are also one area who are able to detect a number which is slightly more than the fraud detected by the statutory auditors. Now, someone may think that why is all the responsibility cast only onto the statutory auditors? I mean, there are so many other experts working with the company, and when I say experts, I mean the external experts who also touch the company's books of accounts. Let's say there is a tax auditor, or there is an internal auditor, or there is a practicing company secretary who gives the certificates, annual certificates for secretarial compliance, or there is a cost auditor for that matter. So we'll touch upon all of these one by one very quickly. Now, on the use of the internal audit report and fraud reporting, so it is kind of expected from the statutory auditor that he would, in his normal process of mitigating the risk of fraud, he would have examined all the reports of internal auditors with a view to ascertain whether is there any fraud reporting, or is there even any hint of let's say hint of certain benefit being given to any employee or to the management which they were not entitled to. So all those hints needs to be identified by the statutory auditor by going through the internal auditor's report in detail. Then the auditors are also required to attend the audit committee meetings where the internal auditors are presenting. We've seen practically what is done is statutory auditors would go, they would make their own presentation in the audit committee and kind of move out of the audit committee. What we have seen, and I personally strongly recommend that the statutory auditors should sit through the entire audit committee meeting. They should hear the presentation of the internal auditor. They should go through the minutes of the audit committee. They should go through the discussions and then try and see if there is anything they want to catch out of the discussions of the audit committee meeting. And it's just being professionally skeptical and being more alert is what is needed. And then auditors should inquire with the management about any fraud or the company. Now, generally, someone may say that based on a normal inquiry with the management, management will never say that there is a fraud in my book. No one will say that. I mean, if they are party to the fraud. So generally what we suggest and what we do is we draw up certain questions pertaining to the controls, pertaining to the operations, and pertaining to how the business has been doing or other areas. And then the same set of questions are asked by different process owners, including the management, including the CFO, including the team downline below the CFO, or the other process owners, the HR and all. And then we try and correlate the answers received from each of them. And so if you find a varying or a differing answer on particular set of questions, there we know that because so at least there you get a starting point. And then obviously you may want to investigate further, or you may want to deliberate that further with the management, or increase your audit procedures to ensure that everything is okay, or if there is something which you want to dig further, you may want to do that. So procedures like these needs to be thought through. Not only reliance on internal audit, that's not enough, or that's not sufficient. Again, building of unpredictability procedures. My friend Rajiv will probably dwell more in his presentation. But these are the activities, these are the things where one would need more emphasis on. We catch the management on the wrong side, catch the management where they are not aware. Add those areas like a cash count, surprise cash count. So they're aware that you're going to do the cash count on March 31. To do a cash count probably 2 days before or 3 days after the year end, and things like that, where you catch them unintentional. Okay. Now coming back to section 143.12. Again, this is extremely important from 2-3 aspects. One I had already mentioned, what is the timing of the statutory auditors reporting, A, to the audit committee or the board, B, to the central government. And also, is there a threshold beyond which the cases are to be reported, A, to the management, which is the audit committee or the board, or is there a different threshold for reporting into the central government? So all this we will probably cover in our subsequent slides. But before that, these 3-4 sentences are extremely important. So I will go very, very slow. Please try and absorb all these. Each word will have a specific meaning for us to conclude. And then there is a decision tree also to help us identify as to what exactly is expected out of the statutory auditors in case of a fraud. Okay. Where auditor, in the course of performance of his duties, right, has reasons to believe. And what is defined as reasons to believe, it is very clearly elaborated both in the guidance note as well as in the rules. Okay, has reasons to believe that an offense involving fraud is being or has been committed. So either it is continuing or it has already been committed against the company by the officers or employees of the company, right? It does not include vendors, right? There, the auditors to immediately report the matter to the central government, but not later than 60 days. 60 days is basically a breakup of, let's say, 45 days, which you will give to the management to respond to your observation. and then 15 days for the auditor to report to the central government. And I have a slide basically as to how procedurally this needs to be done. And then it includes only fraud by the officers and employees of the company and does not include any third party, which is vendors or customers. So those frauds are not required to be reported by the auditor to the central government. However, from what we have practically seen, there is a whistleblowing done directly, whistleblowing report or whistleblowing calls directly received by the statutory auditors. You cannot ignore them. I'm nowhere saying that if it is not pertaining to employees or officers of the company, auditors is not required to do anything. No, this is only on reporting. So any kind of information that the auditor would receive either directly through whistleblowing or again through whistleblowing, but through the management or through any other activity, or if there is a reporting done by any other expert where the auditor has got the knowledge that there is a fraud, all those things needs to be adhered to, taken care of. To get additional comfort, auditor may finally conclude that he is not happy with the procedures or let's say with the information shared by the management, or where there is a scope limitation. So it will depend, then the question will come, it will depend what kind of comfort the auditor has got. If he is comfortable, then obviously he gives a clean report. If the auditor is not comfortable, it could be a case of qualification or a disclaimer or an adverse, depending on the pervasiveness of the matter. Okay. So just going a little bit further, I talked about the requirements of the statutory auditors. So 143(12) of the Companies Act casts the responsibilities, as we have discussed, on the statutory auditor, and this includes the branch auditors also. So branch auditor can't leave it to the parent auditor or the auditor of the main entity that he will report, I have nothing to do, I have told him, so I am done. That is not accepted. It is the responsibility of the branch auditor to report directly, I mean, following the process, but finally directly reporting to the central government. The cost accountants are also covered. If cost accountant is providing the cost audit reports under section 148, and if they catch the fraud, they are also required to report directly to the central government, obviously following the due process. Company secretary, I mentioned in the beginning of my presentation, company secretaries are also required, are also covered under 143(12). Now, who are not covered? So the tax auditors are not covered. The GST auditors or the VAT auditors, sales tax auditors are not covered. And internal auditors are also, kind of not covered because they are not covered within the definition of specified person as required under 143 subsection 12. So I think this slide is extremely important, where it gives a clear distinction as to who are required and why, and who are not required, and what is the process that needs to be followed. Rule 13. So till now we know that there is this SA 240, which is extremely important, which talks about frauds and procedures to be adopted by the auditor. Then we are aware that there is this section 143 subsection 12. And now this is the third document, which is Rule 13 of the Companies Audit and Accounts Rule, which primarily dwells the process. So it says, if an auditor of the company in the course of performance of his duties as statutory auditor has reasons to believe, so we will come to what is reasons to believe and what is the course of performance of his duties, that an offense of fraud which involves or is expected to involve individually an amount exceeding rupees 1 crore or more is being committed or has been committed, the auditor shall report the matter to the central government. So if the quantification is possible, and if the quantification has been done, and the amount is more than 1 crore or 1 crore, then there is a mandatory requirement of the auditor to report the matter to the central government. Now, what happens in a situation where the amounts are not less than 1 crore? what are the auditor's responsibilities? So it's very clear. I mean, the process is same. The auditor would identify, or the auditor would report to the board or to the audit committee as applicable within the 2 days of the knowledge of the fraud, of fraud taking place, and give them 45 days. Then means the management, the auditor would give the management a period of 45 days. So 45 elapsed days, not working days. 45 days to respond to the noting done by the auditor. And so once the observations are, once the auditor receives the comments from the management, then the auditor will have 15 days to report it to the central government if the amount is more than 1 crore. If the amount is not more than 1 crore, then the auditor would probably analyze and see the management comments and see whether they are happy with the management comments and whether they still believe that the fraud has taken place or no, or basis the note, the auditor would want to design their audit procedures and then conclude accordingly. Okay, now on the last paragraph, it says that in case the auditor fails to get, now what happens in a situation where the management does not reply? And practically speaking, I can say this with my experience. Out of 10, 8 cases will be such where management or the board or the audit committee, they will not respond at all to this, and then do a verbal communication with the auditor and try and pacify and all, because they know the moment you receive the response, it gets formal, it could be litigated, they're in a high risk that the matter would reach the central government and all. So what does the standard say in this situation? So I just read it out and then probably will. So in case the auditor fails to get any response on the observations from the board or the audit committee, in this situation also the auditor is required to forward his report to the central government along with the note containing the details of his report, which he had shared with the audit committee, and also stating the fact that the management has not responded to the observations. So it is mandatory. So beyond 1 crore, any situation, whether you receive or you do not receive, within 60 days, the count I had shown you in the beginning, 45 days you give to the management, you don't receive any response. Even in that situation, also within 15 days, you need to reach out to the central government. Okay, and how do you send it? I mean, that is also clearly, defined in the rules and in the section. So there is this form ADT4, which basically it's a 3-4 pager form. It has basic information as to how the fraud was detected, what is the amount, who's involved, what is the timing, and what is the kind of evidence you've got. All those factors are there. And ADT4, that ADT4 form needs to be submitted, and the report of the statutory auditor on the fraud needs to be sent to the Secretary, Ministry of Corporate Affairs, through registered post, right? And obviously you will follow it up. You may want to follow it up with an email, but you will need to send this through registered post with an acknowledgement due or through a speed post, and then confirm it with an email. So they are not leaving any stone unturned. People generally send an email and then probably email reaches or email doesn't reaches. They don't want to leave it to that. They want it in the hard copies, either through speed post or through the registered post. And then it is also prescribed in the rules that the report of the auditor has to be on the letterhead of the auditor, containing the postal address and the email address and the contact numbers and the mobile numbers of the auditor, along with the membership number of the partner. So that it is giving them a window. Let's say if they want to reach back to the auditor, they are able to do that. I think this I have adequately covered. If the amount is less than 1 crore, I will move ahead in the interest of time. Okay, so we've talked about let's say the experts who are involved in one of our slides. If you're a GST auditor, what is your responsibility? If you're a statutory auditor, what is your responsibility? If you're internal auditor, what is your responsibility? This slide primarily talks about a situation where the auditor is carrying on certain other audit engagements and not the statutory audit. What happens in that situation? Suppose, let's say the auditor is performing a AUP and then there he gets to know of a fraud. Now, in this situation also, if the amount of fraud detected is more than 1 crore, the reportings are all applicable. There is no change. So auditor tomorrow cannot turn up and say that this fraud was identified by me while performing and agreed upon procedures and not based on the statutory audit. It is not a tenable explanation. It is not a tenable thing. The auditor is required to report, even if they're performing a non-attest services. Okay, now, so we dwell upon as to what happens in a situation where auditor detects. Now, where management detects the fraud. So briefly, we have touched upon. So if the management detects the fraud, or if there is a whistleblowing, or if there is anyone other than the auditor who has detected the fraud, and management then informs the auditor. In this situation, obviously, there is no reporting to the central government. So that SWOT is gone. However, the auditor is clearly expected to perform additional procedures, is expected to gain comfort on the completeness of the fraud, whether the entire population is impacted, or what is the population that is impacted, what is the quantum of amount, how many number of employees who all are covered, how did it took place. Auditor may also ask for investigation either to be done by themselves or, but it is very clear that the board, as per their board responsibility statement, the directors they have to take care of the frauds which are detected, and they have to give a declaration that they have done sufficient steps, they have taken sufficient steps to safeguard the assets of the company and for preventing and detecting any fraud. So the responsibility is cast on the board as well. Right. So board, because they have to give this declaration, it is expected that they will perform procedures in order to give this declaration and B, satisfy the auditors in terms of any additional procedures which may be required. I think this we've covered it. Primarily talks about a situation and an extreme situation where the fraud is detected by the management. The auditor reviewed the steps taken by the management, and the auditor is not satisfied with the steps taken by the management. He's not happy with the reasons given by the management. In that extreme situation, whether an auditor is allowed to evaluate the reporting to the central government. Now, the answer is yes. The answer is yes. If the auditor is not happy with, and in extreme situations, he may want to take the route of reporting it back to the central government, where the fraud is even detected by the management and he's not happy. Okay, so that was primarily on when to report and how to report. Now, what to report? What to report? This is extremely important. So let's say if it is just a rumor about the management, if you have just heard a rumor that management has accepted certain kickbacks from supplier or services provided for awarding the contract, but there is no proof, right? So it is a speculation. It is a speculation, and it does not warrant it is not a fraud. It has no basis for fraud. Or let's say, for example, where based on specific industry risk, there is an assumption that cash cash sales or cash purchase or money laundering. So again, if it is a speculation, if there is no proof, then it cannot be covered. Or if, let's say, we have just heard of media reports indicating that the company is planning to invest in totally unrelated or a high risk business. However, there is no proof, there is no board resolution, there is nothing contrary to that. You have just heard. So a hearsay is a speculation. Hearsay is clearly out of the ambit of your categorization as a fraud. Another example could be where it's a rumor that the promoters of certain companies have accounts in the tax haven, and you don't have any proof, right? You've heard someone in your circle or in a grapevine. That's all informal. That cannot be considered as a basis. You may want to investigate more, but it is not a conclusion. It is not even a suspicion. It is a speculation, right? So in terms of identification, you start with a speculation, and then there is a suspicion, and then there is a reason to believe, and then there is the knowledge that the fraud is actually there. I think speculation we have covered sufficiently. Now, what is a suspicion? Right. A suspicion is a state of mind which is more definite than speculation, but falls short of knowledge based on evidence. It must be based on some evidence, even if that evidence is tentative. Simple speculation that a person may be engaged in a fraud is not sufficient ground to form a suspicion. Suspicion is a slight opinion without sufficient evidence. So even if you have a suspicion, it still, it's just slightly more than speculation, but still it is out of your fraud. Reasons to believe. What is reason to believe? Reasons to believe to come into existence. Again, reasons to believe means it cannot be based on a suspicion, which means if it is only suspicion, it is not reason to believe. There needs to be sufficient information or convincing evidence. Sufficient information and convincing evidence to advance beyond suspicion that it is a possibility that someone may be committing or has committed a fraud. So let's say, for example, identification of a fraud risk factor is in itself cannot be a reason to believe. So there has to be sufficient information which you have seen and convincing evidence beyond doubt, then you have reasons to believe. And knowledge is obviously the extreme where which is more pervasive evidence further based on the process performed by the audit. Materiality, again, people are quite confused here. Someone says that there is no concept of materiality in fraud. Someone says that please apply materiality. Audits are done based on standards on auditing, and then we should apply materiality. Now the answer is yes. The audit is done based on standards on auditing, and the auditor performance of duties is done based on the standards on auditing. So concept of materiality will apply, and even in but as far as the reporting to central government is concerned, irrespective of your materiality, the thresholds have been defined as 1 crore. So if it is 1 crore, obviously, and if your materiality is higher than 1 crore will apply. In other cases, one may want to see if you're able to demonstrate that you have gone through the complete population and it is below materiality, you may want to deal with it accordingly. Or if you're not able to get complete comfort, then that means you will not apply. Generally, you should not apply materiality because you have not been able to get comfort on the complete population, and you should see whether it is all pervasive or no. If it is not all pervasive, it is a qualification. If it is all pervasive, then it is a disclaimer. Okay, now it's a case of where there are cases of corruption or bribery, whether these are covered. The short answer is that yes, all these are also covered. If the auditor in the course of performance of his duties comes across instances of corruption where there's a bribery which is given, the auditor would need to evaluate the impact, and if it is material, then these are all required to be covered. And then when I say it is required to be covered, you would want to investigate more, and you would want to see whether this is a case of fraud or no. Because if it is a, let's say, money laundering, someone would have taken out the money from the company by booking false expenses, which tantamounts to a fraud. You would want to investigate more and then deal in your auditor's report accordingly. And the reporting structure to the central government continues. If the auditor has detected, it gets covered for reporting. If the auditor has not detected, then you report. Then you take care of the audit procedures. I think again, this income tax example we've covered. If a fraudulent return of income has been filed basis wrong documentation, then it is a clear case of fraud, which is a reportable offense under, it gets covered under 143(12). And again, I'm not talking of tax plan. So what happens in a situation where auditor does not perform the desired responsibilities of 143(12) or SA 240 or SA 250, or what is expected out of them? It is punishable. There is this clause in section 147 subsection 2 of the Companies Act 2013, punishment to the auditors for contravention with the provision. And again, it tantamounts to if it is done willfully or knowingly with the intention to deceive the company or its shareholders, it shall be punishable with 1 year and 1 year imprisonment with some fines as well. Okay, so this table I've picked up directly, this decision tree I've picked up directly from the guidance note on section 143(12). We've covered all these aspects. In the interest of time, I'm moving ahead, but this is available in the guidance note. So all of us are aware, CARO 2020, this is the first year where CARO 2020 gets implemented. There is a paragraph 3 subsection 11 primarily on the reporting of fraud. Here, which means the scope has been widened. They are now covering whistleblowing, the whistleblower complaints received by the company during the year, while determining the nature, timing, and extent of audit procedure. So what this primarily would mean that if there is a whistleblower registered by the company, you would want to ensure that this is complete. You would want to ensure that you have adequately covered in your management representation. You would want to ensure that those whistleblowing complaints have been adequately addressed by the management, and if there is anything which may have an impact on the financial statement, you would have duly taken care of that. And they've also incorporated whether the auditor, if he was required to file ADT 4, which is the reporting to the central government as per section 143(12), which we have read, and as per Rule 13, whether that has been filed up to the date, during the year or up to the date of the report. So they formally put it in the CARO. You have to write a yes or no whether it was applicable, and if you have done it, yes or no. And then the normal clause where instances of fraud has been detected by the company or on the company. Now, management representation. So management representation is not a replacement to any audit procedures. Now, let's say you do not, or the auditor does not identify any fraud, and no fraud has been reported by the management. The question comes still, do we cover this in the management representation? The answer is yes, where the management will acknowledge their responsibility for the implementation and operation of the accounting and internal controls that are designed to prevent and detect the fraud. you will take the management representation on their responsibilities and their confirmation that there is no fraud, and that all the information that was required to be shared with the auditors has been shared for the auditor to identify whether there is any fraud or suspected fraud. Joint audits. So now again, the fraud is let's say detected by joint auditor A. What are the responsibilities of joint auditor A and joint auditor B? Now, in this situation, the responsibility is cast first on the joint auditor A to report to the central government. However, they will surely do it collectively, because the joint auditor A would discuss with the joint auditor B also, because at the end of the day, the report is being signed by both the auditors together. But to pinpoint the responsibility, if both the joint auditors do it collectively, it is well and good. Otherwise, it is the responsibility of the joint auditor A who's identified the fraud. Holding company. Now, the fraud is detected by the auditor of the subsidiary company. Now, what are the responsibilities of the holding company auditors? And let's say if the auditors are different. Again, let's say if the fraud is detected by the auditor of the subsidiary company, and if the company is an Indian company, that auditor is responsible for reporting under section 143 subsection 12, and not the parent company auditor. And obviously there are situations, let's say if the parent company employees and officers are covered, then the parent company auditors are also required to do the reporting. And however, if the auditor of the parent company in India, if the parent company auditors are not, parent company employees are not covered, then I think it boils down to the auditor of the subsidiary company. And from a parent company perspective, they will carry forward any note given in the auditor's report of the subsidiary company. I think broadly we've covered here, and I think standard requirements of the standards on auditing, my fellow colleagues would want to take it up in great detail. Happy to answer questions.
Thank you so much, sir, for wonderful deliberation, sir. Sir, can you hear me?
Yes, sir. Yes, sir. Yes, sir. Please go ahead.
Sir, thank you so much for wonderful deliberation, sir. It was to have you over here, sir, and it was really very detailed and in a very lucid manner. Frankly speaking, I have gained a lot through your deliberation, sir. Sir, if you permit, I have 4-5 questions. So may I take right now, sir?
Absolutely, sir. Yes, sir.
Okay, sir. Okay, sir. So first question is, does non-cooperation from the borrower to submit the required documents and information indicates fraud? Non-cooperation from the borrower to submit the required document and information, that indicates it's a fraud.
So again, I mean, this falls in the category of suspicion. But from an auditor, so it's a suspicion, but you have not been able to demonstrate that this is a fraud. From an auditor's perspective or from the company perspective, these are serious indicators for the company to dwell down further. However, no conclusion can be drawn because this is a suspicion.
Yes, yes. Sir, if any person not registered in GST due to the exempted item, however, this turnover is more than 1 crore, and this is there, any risk to tax auditor in doing tax audit?
So technically, the tax auditor is out of the ambit of 143 subsection 12. The other auditor, I mean, if the other auditor, the main auditor, if he gets to know of this, then he would be required to report to the central government.
Yes.
The GST auditor and tax auditors are exempt. Sorry.
Yes.
Please continue.
Yes, sir. Yes, sir.
So I was saying that GST auditor and tax auditor are not covered technically in 143.12.
And in relation to this, one member is asking, fraud by the company is anywhere covered in the Companies Act?
Yes, fraud by the companies are covered under Companies Act.
And can auditor examine vigilance records to determine fraud in case of government company, sir?
Auditor has access to all the records of the company, and any doubt that the auditor has in his mind, he is entitled to go back to the management and satisfy himself. He should not be issuing the report unless the auditor is completely happy and satisfied with the work with the documents that he has received and the work that he has done. Gone are the days where you would probably rely on verbal discussions and on faith and trust. There's no faith and trust anymore. It needs to be verified.
Yes, sir. So one last question. A member is requesting. He's saying, with your vast experience of so many years, can you just help us or indicate some key or red flags or which thoughts you have mentioned in your presentation?
I think the biggest red flag, there are many things. Let's say, you start with capacity utilization. I mean, if you look at the actual sales exceeding capacity utilization, you clearly know that this is not a possible scenario. And debtors not paying up. I will not be happy if debtors are not moving and not paying up beyond 180 days. I would want to suspect that whether actual sales were made or not made. So each and every line component, if it is non-moving, you may want to have a comfort on the occurrence of the transaction. If you're not getting comfort on the occurrence, then that means those could be mere book entries and fraud. Many examples. Utilization of loan. You're giving the loan to your related parties, and related parties circling it back, evergreening, many things. You just need to be alert, and gone are the days where you would just pick up the trial balance and do a voucher checking and then move on.
Yes, sir. Sir, thank you so much, sir, for such a wonderful deliberation. And on behalf of WSB of ICI, I extend my heartiest thanks towards you for sparing your valuable time, sir.
Thank you.
Thank you so much, sir. Thank you.
Thank you so much, sir. Thank you.
I would also like to thank you, Amit. I think it was a wonderful deliberation.
Thank you.
Yeah.
Thank you, Rajiv.
Yes. Once again, on behalf of WSB, I welcome our learned speaker, another co-learned speaker, Sri Rajiv Saxena ji. Welcome you, sir.
Thank you.
Sir,
thank you.
Moving on to the next technical session relating to the SA 240, that is the fraud, risk and audit procedures. We are having with us our learned co-speaker, Sri Rajiv Saxena ji. So without wasting much more time, I request Rajiv sir to please deliberate and enlighten all of us on the topic. Over to Rajiv sir, please.
So thank you, sir. Thank you. And thank you once again to Amit for such a detailed deliberation. I was actually thinking of using some of his time because I thought maybe only covering 143.12 might not take 1 hour, and I would be needing more time for broad procedures which are quite detailed, and it's such a complex topic. But I think that the way he is covered, I think it is excellent, and I'm sure the audience and the participants must have benefited out of that. But I would like to share and make a comment that since fraud is a very complex topic, so couple of things or many of things which Amit ji has covered in his presentation and his deliberation might be part of my presentation also, because otherwise I will not be able to make the context of the discussion. So you'll have to bear with me for some duplication, but I'm sure that this is extremely necessary to have those discussions in order to understand the context of the presentation. So if I talk about the presentation, it is divided into 6-7 key sections, and then some of the case studies also. So introduction, briefly about the fraud gamut and overview of the fraud situation, then core audit workflow, definitions which have been covered, but maybe I would like to talk about some of the specifics within the definition. Then types of fraud, objective of auditors, which is the key subject matter given the standards which we are discussing. The preconditions to commit fraud. So you will have, I think, from some of the audience asked about, some situation which might give you an indication. So we will talk about some of these situations. The preconditions to commit fraud in the context of COVID-19, because we have passed through that difficult, challenging time of 2 years. For some industries, it is still not over. So we will talk about some of the preconditions which probably emanated during the COVID period. Then common methods used to commit fraud, examples and circumstances that indicate the possibility of fraud, responsibility of management for fraud prevention and detection, responsibilities of auditor, compliance requirement under SA 240, and some case studies. So not wasting a lot of time because I have left with only 45 minutes. So if you talk about I think though we have listened to Amit, and it was he covered the responsibilities and all. So I would like to reiterate that the primary responsibility, first and foremost, the primary responsibility for the prevention and detection of fraud is that of management and those charged with governance. It is important that management, with the oversight of those charged with governance, place a strong emphasis on fraud prevention, which may reduce opportunities for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud because of the likelihood of detection and punishment. So if there is an environment which clearly give the message that any wrongdoing which immediately will be detected, because the monitoring is so robust, and probably the outcome of those detection will not be easy, it will be severe, then probably if we are able to establish that kind of environment in the company or the business, I think that makes the road easy in terms of having a strong mechanism in place, which includes the vigil mechanism also, or whistleblower mechanism also. The second responsibility, or the second responsibility, is that of auditors. We are responsible for obtaining reasonable assurance that the financial statement taken as a whole are free from material misstatement, whether caused by fraud or error. So the risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. This is because fraud may involve sophisticated and carefully organized schemes designed to conceal it, such as forgery, deliberate failure to record transactions, or intentional misrepresentations being made to the auditor. Such attempts at concealment may even be more difficult to detect when accompanied by collusion. So if a large set of people are involved, including some of the top management, very difficult to detect that. It is therefore important that we maintain professional skepticism throughout the audit, and I will talk about that in subsequent slides. Consider the potential for management override of controls. I think this is one of the main risks which we should be working around while forming the risk-based audit procedures, and recognizing the fact that audit procedures that are effective for detecting error may not be effective in detecting fraud. So detecting error, you might have very robust procedures and detailed comprehensive procedures, but you'll have to be mindful that those procedures alone may not be sufficient to detect instances of fraud which could result in material misstatement. So what are we covering today? Auditor's responsibility relating to fraud, and how SA 315 and 330 are to be applied in relation to risk of material misstatement due to fraud, based on the guidance and based on the process which is given in SA 240. So we are all aware of the key audit workflow, and but I'm still taking 1 minute to reiterate or repeat on that. So the audit workflow starts from the process of acceptance or continuance, and then understanding the entity, which is maybe one of the key steps, obtaining an understanding of the entity's business and its environment. So tone at the top, the kind of procedures, the controls, the the automated controls which have been put in place. Then financial data, which includes preliminary analytical review and collection of financial data, performing some kind of ratios which can give you an indication of the company's performance vis-a-vis past result, vis-a-vis industry. Because there are certain industries where the trends are quite clear, and if your company is doing quite differently from those industry trends, then there is a reason to believe, and there is a reason to build procedures around that. And then audit strategy, which is a risk-based audit approach and audit planning. Fieldwork, which is audit procedures and review of that. And then the completion, which includes audit report and archiving of data. So the important point which I'm trying to communicate here is this is the audit workflow, but fraud responsibility and awareness in the core has to exist in each of these steps, right from the process of acceptance. Because when you do acceptance analysis, that you do a lot of research on the background of the people or the promoters or the key managerial person, the businesses, the reputation of the company. So I think so the fraud responsibilities and awareness about the possibilities of fraud and that need for a professional skepticism had to be inbuilt in all the steps which we follow in a core audit work, right from acceptance to understanding of the entity to financial data analysis to audit strategy to field work and to completion for sure. So this is prevalent in all these key steps in an audit workflow. For definitions, I think Amit has spent a lot of time on definitions, so I will not spend, but I think I would like to still spend some time on the misstatement is because of the error and because of the fraud. Here we are covering the misstatement because of the fraud, and fraud is of course intentional, because if it is not intentional, it is an error only. That we clearly know. But if it is intentional, it could be misstatement resulting from fraudulent financial reporting. So you are suppressing certain information from disclosure, or you are making information maybe in a way which is not correct, or doubling it, or maybe disproportionate to the rest of the financial items within the financial statement. And then the second category is misstatement resulting from misappropriation of assets, which is about willful gain and willful advantages. Having said that, willful advantages or gain could be, or rather the word is that undue gains could be because of misstatement from resulting from fraudulent reporting also, which could be for the company as a whole. So the intentional act by one or more individuals among management, TCWG, employees or third parties involving the use of deception to obtain an unjust or illegal advantage. So this is what the definition is. And this is a classic triangle of the fraud, which we should keep in our mind while performing the audit procedures. So one is, what is the incentive? Do you see any incentives or pressures amongst the management or amongst the employees to think about committing a fraud or thinking about taking an undue advantage of the situation of misstatement or misreporting or fraudulent reporting, or for that matter, obtaining undue gain or unlawful gain. And then the opportunity, whether the environment which is set up in the company is robust enough, or there are some areas which are not monitored properly, so which gives an opportunity to the management or the employee to think about that. And then the attitude. So if you identify, let's say, a non-compliance, and you go to the top leadership and they say, no, why are you bothered about this too much? It is a small incidents, and you should not be spending too much of a time on that, and then they don't listen to, or they don't give enough importance to these kind of misses or slip-ups. Then probably if these three things are combining and maybe are existing, then the possibility of fraud is quite very much there. So this is on the fraud triangle. So this is these are the three factors: incentive, opportunity, and attitude. So if you talk about types of fraud, so as Amit covered in his presentation, that corruption is also is covered basically, but the two main types of fraud which are covered in SA 240 are misappropriation of assets and fraudulent financial reporting. So corruption, as he mentioned, bribery, extortion, gratitudes, conflict of interest. So this eventually may lead to some of the misappropriation of assets. So you have to clearly see the link, and then accordingly take the necessary steps in designing your audit procedures or designing your response to these kind of situations. But the two frauds which are primarily discussed under SA 240 are misappropriation of assets and fraudulent financial reporting. So if you talk about misappropriation of assets, some examples are cash inventory, fixed assets theft, skimming, larceny, billing schemes, payroll schemes, expense reimbursement, payment tampering. So these are the kind of things which are there. Okay. Sorry, Anilji, are you not able to see the presentation? I'm extremely sorry. I've just been informed that probably the screen was not visible. So should I go back, or should I restrict it here, because most of the discussion which I had so far was covered broadly covered in Amit's deliberation. So I would start from here in the interest of time. Okay, thank you. So I got confirmation from Anilji that it is okay now. So I'll start. I'll continue my presentation from here. So as I mentioned that two kind of frauds, or two types of frauds which are covered under SA 240 are misappropriation of assets and fraudulent financial reporting. Some of the examples in misappropriation of assets are skimming, larceny, billing schemes, payroll schemes, having ghost employees and then charging of expense into the P&L, expense reimbursement with a fraudulent scheme, payment tampering. And fraudulent financial reporting primarily covers timing difference, so postponing the revenue or preponing the revenue to show better results, fictitious revenue, concealed liabilities, not creating enough provisions, improper asset valuation, either overstating or understating, depending on the benefit which might be there by those improper asset valuation, and improper disclosures, which may not be or either incorrect disclosure or inadequate disclosure. So these are the couple of examples of fraudulent financial reporting. Moving on to objective of auditors. So to identify and assess the risk of material misstatement of the financial statement due to fraud, and to obtain sufficient audit evidence regarding the assessed risk of material misstatement due to fraud through designing and implementation of appropriate responses. So this is broadly the responsibility of the auditor in a financial statement. If we move on, and to respond appropriately to fraud or suspected fraud. The precondition to commit fraud, this I was talking about in the previous slide, that the precondition to which is a triangle also, the pressure or incentive. So sometime the management incentives are designed in a manner which is dependent on the top line or the bottom line, and then the key management persons or maybe those who are responsible for those kind of results are under pressure to deliver that kind of performance. So these are the pressure or incentive, and these top line may result into higher variable pay or other advantages or incentives which are available to KMPs. So this is the reason or the pressure or the incentive. And then the opportunity. If the environment is not robust and there are loopholes or the tendency of management override of controls which is not taken seriously by the leadership, then probably there is an opportunity. And then the rationalization which I talked about, non-compliances, recurring non-compliances, and when you as an auditor reach out to the leadership or the team or the board, or maybe the board is the last kind of governing body where you go to, but in between you have various stakeholders, and if the response is a little, I would say, casual, they say, okay, it is not so material, why are we spending so much time on this and stuff like that. So that is where you have to be a little more careful, that there is a tendency to ignore, and then probably which can lead to a larger situation where which can tantamount to repetitive frauds or repetitive misappropriations, or the situations which may it turn out to be instances of fraud, maybe on a smaller case-to-case basis. This may look immaterial, but if you look at in the totality or in a larger perspective, or maybe overall impact of these situations, non-compliances, then probably the amount would be significant, and the benefits could be unlawful. So this we covered already, incentive pressure. So some of the examples of incentive pressures are: financial stability or profitability is threatened by economic, industry, or entity operating conditions, and your investors are expecting specific results or particular bottom line, top line, or maybe certain ratios, and you are under pressure to deliver on those. Information available indicate that the personal and financial situation of management or TCWG is threatened by the entity's financial performance. So if those charged with governance or the management personal financial position or situation is dependent on company's financial position, and you are slipping on certain privileges which are available to you as an individual, as a management, and then you will have the incentive to think about misreporting or fraudulent activities. And third example is excessive pressure on management to meet the requirements or expectation of third parties, which could be banks, or not banks is not good example, maybe investors, or certain other third parties which are interested in your performance and your financial results. In crisis time, management or general management have a high interest to manipulate financial in order to obtain financing or guarantee they otherwise would not get. So if they don't achieve a particular result, they would not have that financing available, which is critical for their working capital management or whatever financial need they may have to run the business in due course of time. Then opportunities, we talked about that in the previous slide in the triangle also. The nature of the industry or the entity's operation provides opportunities to engage in fraudulent financial reporting. The monitoring of management is not effective. And that the internal control components are deficient. And there is a complex or unstable organization structure. So the key management personnel are leaving very, very quickly. There is a high turnover of the KMPs, and maybe so there is a lack of stability. So in this kind of situations, you have opportunities to identify the possibilities of misappropriation or fraud. And the third is attitudes. This I discussed, but I will spend maybe 30 seconds on this. Communication, implementation, support, and enforcement of entities' values or ethical standard by management, or the communication of inappropriate values or ethical standards that are not effective. Non-financial management, excessive participation in or preoccupation with the selection of accounting policies. So I think selection of accounting policies and accounting treatment presentation should be left to the professionals and the experts. But if the non-financial management are excessively involved, who clearly does not understand the regulatory requirement or the framework requirement, and they have a specific objective to achieve by adopting to a policy or a representation of the financial statement, then probably you might have situation where the attitude might not be the right attitude to make sure that the financial statement are best presented and they are not materially misstated. In crisis days, even an honorable chief accountant may manipulate financial in order to save his or her personal job. I think we have seen those crisis situations in the past 2 years and many more in the past. The precondition of committing fraud in the context of COVID-19. So fraud risk may be increased due to the increase in global lockdowns or remote working patterns, as control environment may weaken, or certain controls may not be performed because they can't be performed remotely, and you have not thought about bringing in or introducing alternate control to mitigate those kind of risks which were covered by certain controls which can't be performed remotely, and you have not implemented the alternative set of control. So this is a situation where which is a precondition to commit fraud. The impact of COVID-19 on businesses could be very significant and could put pressure on management to meet performance targets or market expectations. This raises the risk of the likelihood of fraud in the financial statement to a higher level, which requires the auditor to exercise a much higher degree of skepticism. And employees might be under personal financial pressure or justify fraud because incentives, pay raises, bonuses were not provided. We all know that in the last 2 years, various measures were adopted by the management or the companies or the businesses to keep floating, in difficult, challenging situations. Some of the business were not so impacted. Some of the businesses were very badly impacted, and the employees had to face the pay cuts and maybe lack of variable pay because there was no business or very small business not even covering the break-even point. In such kind of situations, the employees have their own personal commitments, they have their own personal obligations, and in order to meet those obligations, they may think about, or they may intend to intend to get into fraudulent activities, and they would very well justify that, because we did not get the pay, or we got half the pay, we had to meet certain obligation, and that's why we resorted to these kind of situations. Not meeting credit governance is a fraud risk factor. We all have seen that the current ratios and various ratios which are monitored by the lenders or the banks or the financial institutions were badly impacted. Despite the fact that there were a lot of relaxations, moratorium extensions were extended by the banks based on the government directives, but still, even after that, certain ratios were not looking good, and it was a tendency, or it could have been a possible reason for the businesses or the management to engage into misreporting or misstating certain numbers, certain financial positions to hide those kind of ratios, or to present those ratios which are not correct or which are not true. So examples of items to consider during COVID: the impact on the financial reporting fraud risk assessment to take account of any arising pressure at the year end, any changes to the risk of misappropriation of assets, sudden, unexpected, and existence threatening. So these are some of the risks which you should consider, some of the items or examples which you should consider while defining your audit procedures. Financial crisis caused by COVID-19 may tempt management to fraudulent actions. Any greater risk of fraud from remote working. For instance, we discussed that certain control could not have been exercised remotely. Whether the management was cautious enough to introduce new controls which could have worked to mitigate the same risk in a remote control environment. So you have to be very mindful, and your professional skepticism should be at the very high level for this kind of situation. And any greater risk of concealment of fraud from the audit team. So some of the responses for these kind of situations: more professional skepticism, as I mentioned, relevant journal entries testing, heightened focus on internal controls and changes to the control structure, greater focus on detailed testing various analytics, targeted new tests in high-risk areas, which you were not doing earlier, or they were not so large in numbers. You might have to increase the intensity, the number of tests. Involve forensic specialists if you have a reason to believe, that there might be a situation which not be fundamentally correct and it can amount to a fraud. Then you can involve a forensic specialist and perform additional procedures to respond to increased risk. Common methods used to commit fraud. So these are some of the common methods, like creating fraudulent physical document and transactions. So you might be given a fake document which you rely in your audit procedure, and then your decision or your comfort on a specific transaction or specific number, specific line item may not be appropriate because the document itself or the underlying evidence was a fake or a manipulated document. Altering physical document transactions in accounting systems. So it is in the present IT environment, even if some of the records, bank statements which are issued by third parties, invoices, can be altered with the specific informations, and then probably the result will always be not the same which you would expect maybe in a real transaction. So whatever altered information is giving you the comfort, maybe by completing the trail of the transaction or three-way match and things like that, then probably you would not be relying on the right kind of document. And then altering electronic documents or files, and then creating fraudulent journal entries. So these are some of the methods used by fraudsters to commit fraud. Examples of circumstances that indicate the possibility of fraud. So board members and senior management, highly contingent or incentivized compensation plans, transaction with board members and their companies. So if related party transactions are too many in numbers, then they could be examples or indication of possibility of fraud. So your professional skepticism should help you to have a to design the right audit procedure and to have the right response in these kind of situations. Financial transaction and practices revenue. So significant period in transaction. So you see that the sales was quite normal, let's say, in the 11 months, but in the last month, which is March or could be December, in some companies, if they close their statutory account in December, that the last month sales is phenomenal, which has never been the case. And you could not see maybe a trend in last 3-4 years that the December sales or March sales would have this substance. Then probably it may be true, because if there is a immediate demand in the market, if the market dynamics are such that all the players in that industry have the same kind of situation, then it would be okay. But this will definitely give you a reason for suspicion, or maybe your professional skepticism will help you to go deeper into these kind of situations. Larger or one-off transactions. So you come across a transaction which is very significant, very large, and you have never seen this kind of transaction in the past, and there was no indication of this transaction in any of the of the budgets or the forecasts which were presented to you and stuff like that, and you see that transaction, when you arrive or when you start the field work or when you start discussing, then you have to design your procedures around that. New large or unusual customers. So you always do top 20, top 50, top 100 customer analysis, and you suddenly see that there is a customer which is probably which is constituting maybe 5% of the total sales or 10% of the total sales, which is completely new. And you should do, as an audit procedure, a proper background check. What was the how this customer was achieved. What was the convincing kind of the responses which the marketing or the business promotion team could present to this customer, which attracted such customer to be starting business with your company or with your client. So you have to have specific procedures and questions and analysis built around that. Side arrangement relating to delivery schedules, storage, returns, replacement of credit, which may be maybe in a fine print or maybe in some other document, or may not be documented at all. It's a verbal arrangement which has been done with certain customers, and you may not be aware of that, or you get some indication of that in some return which comes back to the company after, let's say, less lapse of 9 months, because the company has given the customer to understand that you please accept this consignment, sell it. If you are not able to sell it, you can even refund it after the expiry of 12 months, 18 months, 24 months, whatever the case may be. So in this case, you really have to see whether this is really a transaction of revenue recognition or not, and whether it meets the condition of revenue recognition or not. So side letters, side arrangements might help you to, or will give you an indication that this may be a situation of fraud. Financial transaction and practices, expenses. The third area, no vendor screening program, frequent cost or budget overruns, weak disbursement controls, new large or unusual supplier, large related party transactions. So you have to design your procedures around that. And then the indications around information technology system penetrated by outsiders. So your system is vulnerable, and you have not performed vulnerability test, which is called VAPT. You have not engaged experts to help you in that process. Then even if it is not intentional, but you still, this could be a reason for misappropriation or fraud, or maybe involving third parties if your system is vulnerable. Excessive reliance on consultants. You don't have your in-house capabilities, and everything is left out of course, there isn't a standard which enables you to carry out procedures when there are service organizations taking care of some of the very significant functions and processes of the client, but that has also a limitation. So everything is consultant based, and there is a possibility that you may not have enough control. Offline record keeping, no policy or procedures around certain transactions or certain types of transactions, failed or delayed system implementation. So these are the indications, or maybe which can lead to possibility of fraud. And some of the other indicators: off balance sheet transactions, no internal audit review, narrow focus internal auditors, which only talk about some small compliances and does not give you a big picture, incomplete or inadequate response to past frauds or irregularities, unreconciled accounts, including bank accounts, investment accounts, and other intercompany accounts, and unanalyzed journal ledger balances. This is not exhaustive, but some of the examples only, of areas or situations which may indicate the possibility of fraud. Then control environment and systems. So no corporate code of conduct, absence of financial policies and procedures, weak budgetary and forecasting controls, no hotline or other whistleblower reporting mechanism. So, even if you say that you have put in a system in place, but people are not aware, employees are not aware how to reach out to those charged with governance in case of any non-compliances or irregularity. The customers are not aware, the vendors are not aware, then probably you do not have an intention to have to implement a whistleblower system in the true spirit. Undefined or ill-defined financial approval policies and authority, overtly aggressive compensation and bonus programs. So 80% variable, 20% fixed, 80% variable is dependent on so many achievements, and then the management has the tendency, or those charged with governance has the tendency to engage into activities which are not lawful. Then responsibility of management for fraud prevention and detection. So primary responsibility for prevention is those with charge with governance and management. It is important that management with oversight of TCWG places strong emphasis on fraud prevention, which may reduce opportunities for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud, because the action from the management, those who have committed fraud, should be so severe, which discourages, or this will not let them dare to commit this kind of fraud. This involves a commitment to creating a culture of honesty and ethical behavior, and which can be reinforced by an active oversight by TCWG. In exercising oversight responsibility, TCWG considers the potential for override of controls or other inappropriate influence over the financial reporting process, such as efforts by management to manage earnings in order to influence the perception of analysis as to the entity's performance and profitability. Responsibilities of auditor, which is important, and that's why we want to discuss it in a little detail. Obtain reasonable assurance, which we talked about, subjected to inherent limitations of audit, fraud deliberately concealed, so difficult to detect. We all know it is not easy. Nobody would tell you, as Amit mentioned, the management will not come and tell you that, we have committed fraud. So you have to have your professional skepticism in place, and you have to be mindful of all those indicators which we talked about in the previous slide, and many more of those kinds. But exercise professional skepticism to its max. Compliance requirement under 240, so maintain professional skepticism throughout the audit. Recognize the possibility that a material misstatement due to fraud could exist. So this should be always in your mind. Notwithstanding the auditor's past experience of the honesty and integrity of the entity's management and DWG, you cannot have the perception that the management is very honest, or the board members are very forthcoming or straightforward. So there could not be any situation which could which could result in a fraud. So the perception should not be framed. If conditions identified during the audit cause the auditor to believe that a document may not be authentic, or that terms in the document have been modified but not disclosed to the auditor shall investigate further through direct confirmation or with a third party, or maybe using an expert, forensic expert, to get the comfort on the genuineness of the document or authenticity of the document. Otherwise, the auditor may accept records and documents as genuine if these situations are not prevailing. Professional skepticism, we talked about. Trust your gut feeling, record and documents as genuine unless the auditor has reason to believe that there is a contrary situation possible. And where responses to an inquiry of management or TSG are inconsistent. I think Amit mentioned in his presentation that if you have to raise the same set of questions with 2-3 KMPs, maybe CEO or the CFO and head of HR, head of controls, head of risk, head of tax, and you corroborate the responses from all these stakeholders, provided that you have been able to independently get the responses from all these 4-5 KMPs. And when you corroborate and you see inconsistencies, then you have to reason to believe, and then you have to build procedure around that and go deeper into these kind of situations which has given you the indication that there could be something which is missing. Discussion among the engagement team. So discussion emphasize on how and where the entity's FS may be susceptible to material misstatement due to fraud, including how fraud might occur. So the involvement of partner in these meetings are very important. Setting aside beliefs that the management team members may have that management and DSG are honest and have integrity. So if there is a and that's why there is a requirement to to rotate team members and all that, because too much of familiarity or maybe a perceived trust cannot let you deliver the audit procedures or audit responses in the true spirit as required by the standard, if you have these kind of beliefs in your thought process. And then the engagement partner shall be involved in the discussion and determine which matters are to be communicated to those team members not involved in the discussion. So normally you have these discussions at the senior members of the team, maybe manager, director, and maybe assistant manager. But those who are below, they sometimes may or may not form part of that discussion. Then it is the partner's responsibility to inform those team members who did not participate in discussion for the necessary procedures, or maybe the skepticism they should use and the approach they should follow while performing the audit procedures which they have been assigned to. So discussion among the engagement team. So sharing of experience and insight is the key. This comes from the leadership team. There is a reason for missing documents, so the discussion shall place particular emphasis on how and where the entity's FS may be susceptible to material misstatement due to fraud, and how fraud might occur, maybe based on your past experience with the same client or other clients in the same industry, or maybe in similar situations. And the changes and pressure at management level, this also should be discussed. This should, setting aside belief that the engagement team members may have that management and DSG are honest and have integrity. So they also have pressures and an incentive to do or commit fraud. Risk assessment procedure is the key activity or key element of the audit, and obtained from the management's assessment of the risk that FS may be materially misstated due to fraud. including the nature, extent, and frequency of such assessment. So this is a very important, expectation from the of the auditor from the management. Management process of identifying and responding to the risk of fraud in the entity. How frequently they visit, the comprehensiveness of such processes, including any specific risk of fraud that management has identified and that have been brought to its attention, or classes of transaction account balances or disclosure for which a risk of fraud is likely to exist. Management's communication, if any, to TCWG regarding its process for identifying and responding to the risk of fraud in the entity, and obtaining pieces of TCWG, comfort on the system which has been put in place by the management, and management's communication, if any, to employees regarding its views on business practices and ethical behavior. So what kind of environment you have put in place, what is kind of the messaging which is going to the employee, how often you are interacting, how you are, making sure that the new employees who are joining, they also understand the value system which has been put in place, how they are warned or maybe sensitized for the kind of ethical behavior which is needed from all the employees operating in any division in the company. So these kind of things and these kind of process policies are very important, and the auditor should gain complete understanding and knowledge and documentation around this. Then inquiring management or others within the entity as appropriate to determine whether they have knowledge of any actual suspected or alleged fraud affecting the entity. Maybe different process owner might have come across certain activities which might give you an indication. If the entity has an internal audit function, then you have to engage with the internal auditor to identify if they have identified any suspected fraud or alleged fraud or any transaction which is not meeting the eye of the regulation. Unless all TCWG are involved in managing the entity, if they are, then you have to have a different set of questions. Obtain an understanding of how TCWG exercise oversight of management process for identifying and responding to the risk of fraud in any entity, and the internal control that management has established to mitigate this risk. Make inquiries of TCWG to determine whether they have knowledge of any actual suspected or alleged fraud affecting the entity. These inquiries are made in part to corroborate, which we discussed in the previous slide. We evaluate whether the information obtained from the other risk procedures, other assessment procedures and related activities performed indicate that one or more fraud risk factors are present. The fraud risk triangle, which we talked about: incentive, opportunity, and attitude. Assess whether unusual or unexpected relationship that has been identified in performing analytical processes, including those related to revenue accounts, may indicate risk of material misstatement due to fraud. Maintain your professional skepticism. So this is the tree for what we talked in the previous slide: understanding their pressure and motivation, inquire with the TCWG regarding fraud, unusual, unexpected relationship. If you identify, then build your procedure around that. A risk-based audit approach and audit strategy: identify and assess the risk of material statement due to fraud and the assertion level for classes of transaction account balances and disclosures. Based on a presumption that there are risks of fraud in revenue recognition, evaluate which types of revenue transaction or assertions give rise to such risk. The presumption can be rebuttable in some cases, but needs to be well documented if you are not considering revenue as a fraud risk prone financial item. If significant risk is identified related to fraud, it is mandatory, to the extent not already done so, to obtain an understanding of the entity's related controls, including control activities relevant to such risk. So various assessment levels for fraud risk. Revenue recognition is the high risk area, and understand the control for fraud risk around this. Response to the assessed risk of material misstatement due to fraud. Overall response at the FS level. Assign right level of personnel and provides more supervision. Evaluate whether the selection and application of accounting policies by the entity has a management bias. Incorporate an element of unpredictability in the selection of the nature. So if you're performing cutoff procedure and every year you are checking the last 3 days sale, then the management will be very smart not to do anything in those last 3 days. Maybe they will use the 4th day or the 5th, but last day, and they can still sail through whatever maybe they want to do in terms of achieving certain level of revenue or other financial performances. So your audit procedures to a large extent should be unpredictable, so that you can detect various kind of situations. At the assertion level, design and perform further audit procedures whose nature, timing, and extents are responsive to the assessed risk of material statement due to fraud at the assertion level. Specific audit procedure for management override of controls, because this is very important, verify from entity to entity, but it is nevertheless present in all entity. So there is some intention of override due to the unpredictable way in which such override could occur. It is a risk of material misstatement due to fraud and thus a significant risk. So covering in a tree, incorporate an element of unpredictability, risk of management override, and unusual significant transactions. These are the three messages. Evaluation of audit evidence, field work, determine the misstatement are indicative of fraud, the impact of the fraud risk assessment on other areas, whether material or not, if there is a reason to believe that a misstatement is or may be the result of fraud and that management is involved. Re-evaluate the assessment of the risk of material misstatement due to fraud and audit procedure in response. Consider whether circumstances or conditions indicate possible collusion involving employees, management, or third parties when considering or reconsidering the reliability of evidence previously obtained. You might have to re-perform certain transaction testing in order to remove your doubt or suspicion or mitigate the risk. Pay attention to falsified documentation, invoices, confirmation, etc. And at the time of completion, evaluate if the final analytical review indicates a previously unrecognized risk of material statement due to fraud. Obtain the written representation from management and where appropriate from PCW. In a tree, intentional or unintentional misstatement, so intentional are fraud, unintentional are error. Reevaluate the risk of assessment and implications for the audit of identified risk. So you have to see if you are if you find it difficult to continue in the engagement, exceptional circumstances, determine professional and legal responsibilities in reporting to appointing authority, regulator, consider if withdrawal is appropriate, and if withdrawal, discuss reasons with management and TCWG, determine legal and professional requirement to report to the appointing authority and regulator or regulator. Written representation we have talked about. This is about when it is not in the position to complete. They acknowledge that responsibility for the design, implementation, and maintenance of control. They have disclosed to the auditor the result of management assessment of the risk that the FS may be materially misstated. And they have disclosed to the auditor their knowledge of fraud or suspected fraud affecting the entity involving management, employees who has a significant role in internal control, and others where the fraud could have a material effect on the financial state. They have disclosed to the auditor their knowledge of any allegation of fraud or suspected fraud affecting the entity's FS communicated by employees, former employees, analysts, regulator, or others. If the auditor identified, I think this has been covered by Amit. So in the interest of time, I'd like to spend a couple of more time. But in this 260 is important. The auditor shall communicate with those charged with governance any other matters related to fraud that are in the auditor's judgment relevant to their responsibility. So this has been covered by Amit, so I will not spend time on this. Documentation is the key. So significant decisions reached during the discussion among the engagement team regarding the of the entity's financial statement to material misstatement due to fraud, identified and assessed risk of material misstatement due to fraud at the FS level and the district level. Overall response to assess risk and material misstatement due to fraud at the FS level, and results of the audit procedures, including those designed to address the risk of management override of control. So your documentation should be robust. Communication about fraud made to government, management, ECWG, regulator, and others. And if the presumption of fraud related to revenue recognition is not applicable in the circumstances of your engagement, you are required to document the reason in the audit file. Changes in CARO reporting has been covered by Amit, so I'll not spend time on these. These were some of the case studies, but I don't think we have enough time left. So, but Enron was a classic example where the fraud was of such a magnitude for which the company did not survive, and they had to close down the operations. And the second example is this example of Parmalat, where the culture of red flag was aggressive growth strategy. However, many of the new divisions were loss-making, and financing shifted largely to the use of derivatives. the fraud scheme was forged bank account, overstatement of assets, recognition of non-existing assets, diversion of cash to the Tanzi family members, which was the promoter, and 260 foreign entities. So we have created a web where difficult to identify the scheme or maybe perform or extend audit procedures. So I have more studies, but I don't know whether I have time. So I would like Anilji to come in. Should I continue for another 5 minutes, or should we leave it to the question and answer? Anilji, should we, since we have completed or we have passed the time schedule, so should I take another 2-3 minutes, or should we open the floor for the questions?
Thank you so much, sir. Sir, can you hear me? Sir, can you hear me?
Yeah, I can hear you. I can hear you.
Thank you so much, sir, for such a detailed deliberation, sir. And so there are two questions, sir. If you permit, can I ask, sir?
Please, sir.
Sir, we are talking about frauds by officers or employees, but what about the how to report on frauds committed by directors or promoters? It is observed that frauds are mostly committed by them. So how while making audit, how to stop or how to take those into consideration, that is the fraud by the promoters.
Yeah, so if you would have seen in my presentation, those charged with governance, which would be, part of the promoters also, if they are involved into day-to-day operations, and then your procedure will be a little extensive, then you have to have a very, your level of skepticism and audit procedure will be a little exhaustive and cover the tendency and of the management or of the leadership or of the promoters to identify situations where they have tried or they have obtained undue advantage or unlawful gains, maybe by certain practices. So in terms of your responsibility towards reporting to the regulator, or maybe miss a statement due to some certain activities or certain actions of the promoters or the directors, I think as an auditor, you have the same set of responsibility as the fraud would have been committed by an employee.
Yes. Sir, in case of the international auditors, where the holding companies in India and subsidiary companies are overseas, how these fraud audits would operate?
Yeah, so I think if the subsidiary is based outside India, not governed by the Indian Companies Act or Indian regulations, but it's still a significant subsidiary, and you are a holding company auditor, you have the obligation to engage with the auditors of that subsidiary company, provided it is significant enough for you to perform those procedures. And in that process, if you come across of any such instance, so in the capacity of auditor of the consolidated financial statement, as you might have to take cognizance of that reporting into your consolidated financial statement. But the other obligation of reporting it to central government and all that may not be there, because it is the responsibility of the subsidiaries auditor, who is not under an obligation to do so. But all those reporting which have been there in that report, you have to take cognizance of that. And as Amit mentioned in his presentation, even if the subsidiaries outside India are not governed by the Indian regulation or Indian Companies Act, but if that fraud which has been reported by the international subsidiaries auditor involves the management or the employees of the holding company or the company which is the parent company, then you may have an obligation to report to the central government also.
Yes, sir. Sir, is there any difference between fraud and unintentional mispresentation given by the client during the audit?
Yeah, so unintentional error or unintentional misstatement is an outcome of an error, which could be a failure of the systems or processes which have been put in place, which could have been detected, could not have been detected. So there is a risk of not being detected. But if it is unintentional, then it is not fraud.
Yes, sir. Sir, thank you so much, sir, for giving your precious time, sir. Sir, I extend my heartiest thanks towards you. And whenever I call you for any help relating to this essay or any VCM or webinar, you always help us and always available from your precious time. And this time also, you have given your precious time out of your busy schedule, sir. So on behalf of AASP of ICI, I extend my heartiest thanks, sir. Thank you so much, sir. Thank you so much.
Thank you for giving me this opportunity. I'm sorry for the initial confusion of the presentation. I regret the inconvenience to the audience for that. But thank you for this opportunity. Thank you.
Thank you, sir. Thank you so much, sir. Thank you, sir. Thank you.